everyone. Joe DiChiara here, CPA and lifelong entrepreneur, coming to you with lucky number 13 episode of How to Win Big at Business. And if this is your first time here, let me explain what this podcast is all about. I work specifically with self-employed professionals. There's tens of millions of us out there. Yes, I am one of you. Okay, so it's we. And I discuss the obstacles, the pitfalls, the bad stuff that happens along the way, and also the solutions. And today, what we're going to talk about is one of the most important topics facing self-employed professionals, which is the structure of your business. Now, when I say structure, I'm talking about legal and tax structure. So let me give you some numbers. First off, today, February 22nd, 2026, which is when I'm recording this, there are over 33 million businesses in the United States. Over 30 million of them, 90% or close to 90%, let's say it's uh, 29 million, whatever the number is tens of millions of small businesses, and these are all small businesses that are structured the wrong way. And before I let out what I mean by the wrong way, let me qualify those numbers because there are a lot of what I call accidental business owners. And what am I talking about? I'm talking about when this whole gig economy started, when you had Uber drivers, anything like that. If you're selling on Amazon, if you're doing anything that doesn't produce a W-2. In other words, anything where you're not considered an employee, you're a sole proprietor. Welcome to entrepreneurship. You may not have known it. You might have found out the hard way when you went to your tax preparer and got your bill. Because here's the thing, what people don't realize is that you're paying 15.3% in what they call self-employment tax. If you don't know what self-employment tax is, it's Social Security and Medicare taxes. When you're an employee, you pay half of that. You pay 7.65%, and it's taken out of your paycheck. So you don't really feel it. You might feel it, like you might look at your withholdings, say, oh man, why are they taking so much out of my check? But it's paid for. It's paid for as you go. You don't get hit with a big Social Security tax bill when you file your return. Now, the other half is paid by your employer. So that's an expense for your boss. So the people that you work for are actually paying 7.65%. Unless you hit the max, which the max is always going up every year. It's close to 200,000 now, which means at 7.5%, you make 200,000, you're paying 15 grand in self-employment tax. If you make 100 grand, you're paying 7,500 in Social Security tax. Now take that 100 grand and let's say you're self-employed. Your net profit is 100 grand. Your Social Security or self-employment tax is going to be $15,300. Now, you do get a deduction for half of that. So you're going to get a tax write-off of about 7,500, but that's an income tax deduction. It's not going to make up for the 15,000 that you're laying out. Now, let's reduce that down to, let's say, 30,000. Because let's face it, a lot of these small business owners don't make 100,000. In fact, let's make it 10,000. It's a tiny, tiny business. It's a side gig. That 10,000, if you're structured as a sole proprietor, you're going to get hit with a self-employment tax of 15.3%. $1,530 coming right out of the 10 grand that you made on the side. That doesn't include income taxes. So how do you lower that? And I'm not talking about, oh, let's up the exemption. I'm assuming that you're already maximizing your deduction. And if you don't know how to do that, we have other podcasts and information on how to maximize your deductions. What I want to get across in this short episode is how to actually structure your business in the best way possible. So let's talk about what your options are. Your first option isn't even an option. Once you decide to do something for profit, guess what? You're technically in business. Now, the IRS doesn't really care if you're in business and never make a profit. They could care less because the truth is, if you're not making a profit and you file your tax return correctly, you're going to show a loss. And that loss is going to offset any other income that you have. Now, the drawback to that is if you're a sole proprietor and you have a loss, those are the kinds of businesses that the IRS like to audit. Sole proprietorships, for a number of reasons, are the most audited type of entity besides not-for-profits. And not-for-profits is in a whole different category because there's a lot of fraud involved, money laundering, and so we don't even talk about not-for-profits here. So number one, if you're a sole proprietor and you have losses, you're risking red flags. Not only that, if you never make a profit, which believe it or not, a lot of small business owners go through, some business owners never see a penny in revenue, forget about profit. So if you never turn a profit, technically the IRS could say, you're not in this for business. This is a hobby, and you can't write off losses from a hobby. So that's another red flag. So you're automatically a business once you start doing activities to make a profit. And what are activities? Activities are like you get in your car to go to Staples to buy a computer. All of a sudden now that car becomes business use, depending on your business use percentage. But again, that's a whole nother story. So now you're in business. The IRS doesn't really care if you never make any money. They care if you have revenue. If you have revenue, it has to be reported. And it doesn't matter if you have revenue that that produces a 1099. Even if you make cash, you're technically required to report it. If you don't report it, it's technically tax evasion. Now, everything's relative, so depending on the amount, you can or won't get in trouble. What's the amount? Who knows? If it's hundreds of dollars, not a big deal. Now, I'm not telling you not to report it if you make a couple of $100. Chances are, if you made a couple of $100, you probably got more than that in expenses. If it's 10,000, 20,000, that's serious. 5,000, serious. Okay, so that's the risk when you go into business. So the rule is basically the IRS doesn't care if you never have any revenue because then you only have expenses. Then if you only have expenses for 3 years or more, they can say that this is a hobby, you can't take the expenses. So right away, you're getting hit with red flags. On the local level, they care. They care if you're in business. Why? Because you may have to have a license, you may have to have a permit. And what do those produce? That produces revenue and compliance issues. Now, how are they going to know you're in business? Well, all different ways. In a town called, I believe it's Huntington Beach in California, if you have an Amazon store, if you have an online store, an eBay store, an Etsy store, you're required to be registered with the town. Not only registered, but you have to have the license in your window. So think about this. The town of Huntington, Huntington Beach, they can find who has businesses in Huntington Beach on the internet. They can just type in or do a search, however they're going to do it, scan the web to see who has online stores in Huntington Beach. That's one way. Imagine they send out drones. I don't put anything past them because if it can make money, that it's if it's going to produce money without raising taxes, they're going to do it. So imagine them sending out drones to see if all of those businesses have the license. Well, first off, they can just check their database to see if they have a license, and then they can actually go to your house. I don't know if this is legal, but in theory, they can go to your house and see, hey, does this business have his license displayed? Because if it's not displayed, guess what? Penalties, fines, possibly jail. No, I'm joking about that. But so you could see, you can't just really start a business. There's compliance issues. So let's go back to the choices because there's only a couple of them. And most people get very, very confused and they decide to not make a choice. And therein lies the problem. By not making a choice, you're automatically considered a sole proprietor for tax purposes. You don't get a choice. By not making a choice, the choice is made for you legally. So that's option number one. You could decide, hey, I'm okay being a sole proprietor. I don't want to go through all the hassle of being a formal business. I'll register, I'll do all the local compliance that I have to. That's fine. At least you've actually consciously made a decision. Whether it's right or wrong is another story. Now, if there's more than one owner, you're by default a partnership. And now you expand the compliance and the liability, the legal and financial liability. Because first, if you have a partnership, well, you should have a legal document explaining who does what. What's the profit and loss allocation? Who's responsible for X, who's responsible for Y, who's keeping the books and records, and so on. So right now you have a whole nother level of legal requirement. Well, those two choices aren't always the best. So what's the next type of entity? Well, and this is what a lot of people opt for, but for the wrong reasons. It's a limited liability company, LLC, or a limited liability partnership, LLP. So, for instance, let's say you are doctors or a lawyer. Would have to be an LLP because you're a professional, and that's a whole nother story. So professionals, if you need a professional license to run your business, you have to look up the rules for a professional being organized as an entity. Okay, so there's LLC, there's LLP. Well, here's the problem with those types of entities. They do provide limited legal liability, meaning if there's any creditors of the entity, if you've done everything right, you're shielded from personal liability. So let's say you have assets and you don't want the business to, you don't want to have a problem with your business, if a business fails with creditors coming after your assets. So again, legally with the sole proprietorship and the partnership, there is no limited legal liability. If your business owes money, you owe the money. So you get some legal protection with the LLC and or LLP. The problem is that it's a legal designation. It's not a tax designation. And what the IRS says is, hey, that's great. We understand you're an LLC, which is done at the state level. So it's not at a federal level, it's done at a state level. So at the state level, the state is saying, hey, you're a limited liability company. If anyone serves you with a lawsuit, it's against the business, not you personally. The IRS doesn't care about that. But now you have to file your tax return. So the IRS says, okay, here's what the rule's going to be for LLCs and LLPs. You're going to be classified as, we're going to give you a default classification for tax purposes. So if it's a single member entity, limited liability company, you're going to be classified as a sole proprietor. If you're a limited liability partnership, meaning there's more than one owner, you're going to be classified as a partnership. And here's the strange part. You can have multiple owners as an LLC. And I'm not going to get into the idiosyncrasies of an LLC and an LLP. Again, it depends on the state. Every state makes their own rules. So what the IRS is saying, you're either a sole proprietor, meaning you're going to get hit with the 15.3% self-employment tax, or you're a partnership, and partnerships are also subject to the 15.3%. But you have the limited legal liability. So you may wonder, well, if that's not good and sole proprietorship isn't good and partnership isn't good, why do so many people pick the LLC/LLP? And the reason is because when they start doing research, and these people do not have a professional tax advisor, and that tells you everything. They have friends that tell them, they go on the internet and they try to do their own research. And lo and behold, what they're told is the the other choices, which is a corporation or an S corporation, which I'm going to explain what that is, are complicated. Not only that, you got to file an additional tax return. And you might have to, if you have profits, you might have to pay yourself a salary. And then corporations require meetings. You have to have articles of incorporation. You have to have a board of directors. Well, like I said, this podcast is directed towards self-employed professionals, 95% of which are single owner entities. So think about this. The research is telling you that it's more complicated because you have to have a board of directors and you have to have meetings. But if you're a single owner, so let's say you're a single owner of an LLC, so you don't have shareholders, you have what they call members. So if you have a single member LLC, you still have to follow organizational structure, which means you don't have an articles of incorporation, you have an articles of organization. And that basically dictates, why the business is in existence, all, what it does. So it's a legal document, just like an incorporation. You still are supposed to have meetings. So any business decisions that are made requires a meeting, and a meeting of either the members or a board of directors if you're a corporation. Well, if you're a single owner, what are you going to have a meeting with yourself? What you need to do is you need to document what you're doing. Best business practices. You want to document, you want to keep records. So whether you're a single owner corporation or a single owner LLC, if you don't do that, they may be able to pierce the entity structure, meaning that they can say, well, you didn't really operate as a legal entity. You operated as like it's just you. That's a whole nother story. That's a legal issue. So now we're at the point where, well, the IRS says I got to file a separate tax return, and that's true. And if you're a corporation, you probably need to have a tax preparer, and that's going to cost you money. That's true. But if you're an LLC, an LLP, a sole proprietor, a partnership, you still got to fill out a business return. You still have to keep record. Now, if you're a sole proprietor, you don't file a separate return. You file as a Schedule C, which is your business income and loss. The only difference is that becomes part of your personal return. So again, your business and your personal are combined. If there's a problem with your business from a tax standpoint, it's going to have a ripple effect to your personal assets, your personal finances. So, what's the better option? Also, if you're a partnership, guess what? There's a Form 1065. You have to file a separate return. Again, many people that are in the situation wind up doing their own bookkeeping, doing their own taxes, and those are the individuals, partnerships that wind up getting audited. Why? Simple fact, when the IRS sees that the return was prepared by a professional tax preparer, either a CPA or an enrolled agent, or a lawyer, less likely to be audited. Why? Because the IRS knows, well, if they're handled by a professional, the chances of error are a lot less. So now we go to, okay, so if now I've swayed you and you're saying to yourself, well, if a corporation is the better way, what am I looking at? So first off, you got incorporation fees that are paid to the state. Same thing with an LLC. Yeah, you can call up LegalZoom, who are they're not lawyers. Maybe they have some lawyers on staff, but all of these companies that do entities are really order takers. They're not going to give you advice. They're going to do exactly what you ask them to do, whether it's right or it's wrong. And if they do give you advice, don't take it. If they try to tell you what the legal and tax ramifications are, take it with a grain of salt. You might be better off getting the info from your friends or family, which again isn't a good idea. So you got to pay to organize the business. You're going to have annual fees to pay to the state. Okay. You got to keep your records current. In other words, they got to know who the owners are, the address, and all of that stuff. That's what comes with the responsibility of being a business. Now you have to file a tax return. And probably what I'm saying is you need to hire a professional. Well, let me ask you this. Who in their right mind would do something that requires a professional and do it on your own, which is what the majority of self-employed people do, because it's confusing when they do the research. They're scared away. The IRS, the Small Business Administration, will tell you that a sole proprietorship is the simplest form of doing business. Well, yeah, but it's also the most expensive and the entity with the most risk. This is why if you go to a CPA firm, they're going to tell you, listen, well, they might tell you, hey, the corporation is only worth it if you're doing over this amount. We've done all the research, and I disagree with that. Okay. It doesn't matter. This is what matters. In the end, if you have an active trader business, you're either going to want to be a C Corp or an S Corp. And the determining factor is your current tax situation. So why is that? And in my courses, I actually have a nice simple chart. And if you email me, go to Joe at Bedrock 360 Business Solutions and just say, send me the legal structure chart. And what it shows you is if your current tax situation is this, you're an employee or you have other taxable income, whether it's a W-2, investments, a pension plan, so you're already paying taxes. Well, by default, usually you want to be an S corporation. Why? Because if you have losses, like I said, especially if you're just starting out, those losses are going to be deductible against your other income. Let's say you have no other income, you're unemployed, you're struggling to survive, you have no other income, you don't have a pension plan, you're paying nothing or very little in taxes. Well, those tax write-offs aren't going to give you any benefit, not currently. So in that case, what you want to do is you want to be a C corporation. A C corporation has its own tax structure. So an S corporation, you have to file an election to be treated as an S corp. Okay, there's a form you have to file. You have to say, listen, I don't want to be taxed as a C corp anymore. I want to be taxed as an S corp. And the profit or loss flows through to you on your personal return. There's no federal corporate level tax. At the state level, there's probably going to be a minimum tax and or a state income tax, which is even if you're not incorporated, you're going to be paying the state income tax on your personal return. Okay. The reason you want to be a C corp is the losses you incur get carried forward. They're called a net operating loss. They get carried forward until you become profitable. Now, once you become profitable, you want to convert to an S corporation. Why? You want to avoid that double taxation. There's only two ways for you to take profits out of a corporation. Number one, salary. The salary becomes a deduction, and that's the same as an S corp. You make yourself an employee, you take a salary, it's a deduction. The other way is by taking a dividend distribution. Now, a dividend distribution is not a tax deduction. You don't get a write-off on the business. So what happens is, let's say the business earns $100,000 profit. You take 50,000 as salary, so the net profit is 50,000. You're gonna pay 21% in corporate taxes. For argument's sake, let's just say it's $10,500. Let's say 11,000, or let's just say 10,000. So now you got 40,000 left. Well, you take the 40,000 as a dividend, and now you also have to pay taxes on your personal return. So now you're paying income tax, personal income taxes on the corporate dividend, taxes you already paid at the corporate level. So let's say you're in the 30% bracket for personal tax. Well, 20% at the federal and 30% at the individual, you're paying 50%. That doesn't include your state taxes. Well, with an S Corp, those dividend distributions are not, they're subject to income tax, but not subject to self-employment tax. So let's say again, you're in the 30% bracket for personal tax purposes. You're not going to pay 50%. I can't work out the numbers in my head right now, but you're going to pay the regular 30% income taxes. Okay. The dividend distributions are not subject to self-employment taxes, and that's where you save most of the money. Plus, as a corporation, you get more respect. You still get the limited liability that you get with an LLC or an LLP. You have more tax planning opportunities. Your chances on getting audited go from high as a sole proprietor to almost zero as an S corp, and you can sleep better at night. Now, let me address the people that already became an LLC or an LLP. The IRS said, hey, you might have made a mistake when you set up this entity. So we're going to give you an option to elect to be treated for tax purposes as either a C corp or an S corp. So you can actually convert the LLC or LLP into a C Corp or an S Corp. And then there's time limits on when you can elect. If you haven't filed a return, which happens often, you can go back actually 3 years and 75 days. Don't ask me why 75 days. It's the rule. Yeah, but we do this all the time. We get professionals that haven't filed in years. They created the LLC themselves. We get them caught up. We elect S or C status depending on what the situation is. And that's the story. So long explanation, simple answer, by process of elimination, you have to arrive at either a C Corp or an S Corp. Now, the only question is, well, how much is this going to cost me? Well, I can't speak for other firms. I know it's hard to find a reasonable and good accountant now in the United States because there's a real shortage. But I know at Bedrock, what we've done is we've priced our services because we're only working with basically all of our clients are self-employed professional, meaning when it comes to doing the accounting work, it's not really that complicated. It's basically as simple as it comes. We can service our clients very, very adequately. In fact, we have world-class service, and our fees are less than 50% of what other CPA firms charge. Now, I'm not saying that they're charging too much, but we just have a specific niche that I've been working with for over 4 decades. I love working with single owner entities, and we could save you a lot of money. So, what I encourage you to do is if any of this information resonates with you, book a chat with me, book a free discovery call. I'd be happy to give you 20 or 30 minutes of my time. I guarantee you'll walk away with at least some clearer ideas, a clearer picture of what your options are. Go to timewithjoe.com. Again, I look forward to talking to you. There is a small deposit fee, just so that I don't get spammed by people looking to, sell me stuff. But go to timewithjoe.com. If you decide to work with me, you get the 75 bucks back. If you don't, I keep the 75 bucks. I think it's a small price to pay for peace of mind. If this if this podcast resonates with you, if anything I've said makes sense, please follow me. Give me a 5-star review if you're so inclined. If you don't like it, don't follow me and don't give me a review. Okay. Either way, my purpose in life is to serve and help self-employed professionals succeed. To navigate that minefield of government interference, government compliance, on top of all the issues we have to deal with just running a business. Take away, all the tax stuff. We still got to run businesses. So that's my story. I'm sticking with it. God bless. I'm here to serve. Over and out. Thank you. I'll see you in episode number 14. Thank you.